Did you see that the punk rock museum is opening up in Las Vegas?
No.
Yeah, I don't know when it's happening.
I wouldn't have thought Vegas.
Yeah, I know. Like Vegas is like the most least punk city out there.
It would have been punk rock.
It's like,
I don't know,
like Seattle would have been a good city. I feel like maybe
or Seattle. Seattle would make
or Pittsburgh.
I mean, closer to grunge. I think definitely there, but yeah,
like Pittsburgh would have been a good one, right?
Pittsburgh would make sense, like
industrial,
or even St. Louis. Really, to be fair, even St. Louis.
St. Louis would have been great. But all I'm gonna say is like I do like that it is in Vegas because it's only like 4 hours away from me where I currently live. So I'm not gonna complain that it's in Vegas.
Sure. Like so there's obviously other reasons. Self-interest the immortal rule of economics, self-interest governs all.
Did you know that over $5 trillion exchanges hands on a daily basis? That's an average of over $220 billion an hour. Now, how does this much money move every single day, and why does it move the way it does? Here on Drunkenomics, two bartenders who also happen to be students at the University of Nebraska Graduate School of Business are going to sit down and drink to the global economy and try and translate it into English. So sit back, relax, pour yourself a stiff one, and have a drink with us to the comedy that is the global economy. And welcome back to yet another presentation of Drunkenomics. This is the drinking podcast with the economics problem. That's the problem that we have, I think.
Oh, we have more than one of those.
We have so many of those. We don't have any drinking problems, but get those economic problems. So glad you all can join us. Hopefully you have a nice stiff one in front of you, unless of course you're about to drive somewhere. In that case, please be responsible. Wait till you get there and then start tying one on. But nonetheless, I would like to welcome us all back as the less gracious host. I don't know what the VIX is at because I just got tired of keeping track. It's at above 30. That's all I'm going to tell you.
Yeah, 32.45, but okay. Who's counting?
I lost count. Okay, I'm at that phase in my economic cycle that I just completely lost count. I'm the less gracious host. My name is Aaron Wong, and of course, I'm joined by... I lost track of your name, too, on top of everything else.
I am James Goldwater, most gracious host.
So gracious. As a matter of fact, before we talk about our social media, I just want to make a wager with you about the SPX. Because,
are we trying to trade spots because you want to be gracious again?
Just as a wager, I want to be more gracious for 1 week.
I will hear your bet, simpleton. And challenge me.
And here's the challenge. I think the SPX is going to stay above 3,600 throughout the week. That's just me. I'm not trying to tell anybody to trade along this. I'm not saying like, sell a put spread or anything like that. I'm not doing. Please don't, off of.
And we're just going to go on closings, right? Not like a dip during the day.
Correct. Yeah. So it's got to
close below 36 for me.
Yeah. Friday.
Yeah, I'll take it.
Friday. What day is Friday? The 14th. Friday, October 14th. Yeah. Right now, it's Monday, October 10th. SPX is at 3612.39. I think it's going to stay above 3,600 because I'm just looking at a chart, and this is just a complete guess. I'm looking at the 3-year weeklies and the 200. Moving average, the 200-week moving average, I guess in this case, is...
and you're seeing some support?
Yeah, I'm seeing some support. It's going to bounce off of that 200-week moving average because 200-day moving average just flows off the tongue really well, but since I'm looking at the weekly chart, 200-week moving average, it's right there. I mean, the SPX is right there. I think it's going to bounce off of that for a little bit before it breaks through that support. That's all I'm saying. That's my thesis.
I'll take the counter side of that. I think we have CPI numbers coming out this week, and I think... that and other data is going to point to inflation that's not going in the controlled direction that the Fed hopes, and that will cue everyone into the fact that on top of the jobs report, the JOLTS report out of last week, that we're going to see, we'll still see another 75 basis point rate hike.
Yeah, well, and I think...
or that none of the data will suggest anything to the contrary.
Yeah, well, I think last week was a big week because of, one, the JOLTS report on, I think, Monday or Tuesday, or whenever it was last week. And then Friday, non-farm payrolls came out. So, we have job openings and then employment. So basically, the reports that tell you what unemployment looks like and what employment looks like.
Yeah, because remember, like we've talked about unemployment in the past. Unemployment's a very interesting metric to look at because it's how many people are looking for work that can't find it. Versus, it stops counting people that aren't looking for work and can't find it.
Exactly.
And whereas the JOLTS then looks at the jobs. Yeah. Are jobs being filled? So you need to take them both hand in hand. It's peanut butter and jelly.
Yeah. I also want to correct myself because last week I think I said the expected job openings. What did I say? Was it? Yeah, so job openings did plunge by more than 1.1 million last August. The expectation, I think, was there was supposed to be about 11 million job openings, but it came in at 10 million job openings. So I roughly, I'm just for sake of round numbers, because it's easier to say, I'm giving myself a little bit more leeway. So there were 10 million job openings. They were expecting, I think, about 11 million job openings.
Yeah, they were expecting about 11.2. They had about 10.05. Just more than 10.
Yeah,
and so it was a 10% drop from what was expected.
Yeah,
what was reported in July, rather.
Yeah, so I think, I think from your angle, and I'm just trying to support your argument, I'm not trying to put words in your mouth. I'm just saying, I think what you're also kind of looking at is when economic numbers look like that, that means that businesses are cutting back on labor because they're not so sure that people are going to keep buying whatever good or service that they're trying to sell. Because of that, earnings revisions might be in the sights soon.
Yeah, well, it shows one of two things: either that they've filled the positions, or that the positions are no longer there to fill. And in this case, I think we can conclude that it's the positions are no longer there to fill, because a lot of factories are looking at slowdowns going, we don't need as many people, we don't expect as much growth.
Yeah, it's like, normally we would need to make 1 million widgets, over the course of a month, but now, because the economy is slowing down, not as many people are buying cars. Because of that, we only need to make 800,000 widgets or whatever it is. And to make 800,000 widgets, we only need 2,000 people instead of 2,200 people, right?
Exactly.
So, whereas they had 200 job openings, they took those down because it's like, we don't need those anymore. Multiply that across, the aggregate economy, a lot of other factors, a lot of other different companies. And yeah, that's what we have. But I just think, I'm too much of a technical analysis guy. So I think we're still going to bounce off of that 200 week moving average. Is that what I said earlier?
You did.
Yeah.
Yeah, the 200 weeks. So I think that, and I understand, I respect that position from a technical standpoint, but I think that, looking at that, I would agree with you. That being said, I think there's other data that's going to come in that's going to disabuse a lot of the market of the idea that there won't be. You have some of these big names coming out saying the Fed can't afford to keep raising rates like this, and then you have some others just going, they're going to, because you're sitting here talking about this issue, and they're here talking. They're not looking at that issue. They're looking at a very different issue. And also, your threat is this may happen in 6 to 9 months, whereas they're looking at inflation and they're going, this is currently happening.
Right. Exactly. But
so it's
and honestly, to your point, like, we could easily hit that 200 week moving average. My bad. And just break right through it, and that 200 week moving average now becomes support or resistance. Gosh, I'm backwards. Like, that's what happens when I drink till I do. But yeah, it could break through immediately, and then next thing you know, it tries to go back up. The market psychology sees a dip, buys the dip, and all of a sudden, big sell off as soon as it goes back up and touches the 200 week moving average. That could very much be the case. But I'm gonna bet on the prior, right? And and say that it bounces.
I get it. I think you might be right. I just
because it's too shallow. Like, this recession, if you want to call it that, I'm calling it that. But if you want to call it a recession, I think it's very shallow. I think it's going to last a long time, and because of that, there could be some market consolidation here. I think we need the 50-day moving average, or I guess in this case 50-week moving average, to have a steeper downslope before it really does break through that 200-day moving average, 200-week moving average. I'm looking at the weekly charts. So that's it's my thesis. I could be wrong, but before we go on, I think should we give our social media a shout out? I think it's deserving.
We should. So if you want to check us out on social media, find us in the metaverse, which is Facebook and Instagram, or on Twitter. And the tags for all of them is Drunkenomical, Drunkenomical. Drunkenomical.
There it is.
Nice. And then from there you can find an invite to the Discord where you can jump in, join the conversation, and hang out with all the other econoholics and drinkonomists.
Absolutely, yeah. Love hearing from you guys. Speaking of our econoholics or drinkonomists, I don't know which one you fall under, but Todd, dude, great to hear from you, man. One of our guys in our Discord channel, by the way, it's free to all. He was talking about a life decision that he made recently. He got a new job or accepted a new job at a different company. Dude, awesome. First of all, I just feel honored that you feel comfortable enough sharing that stuff with me. It means a lot to me.
That's pretty cool.
Yeah.
But also definitely playing chess, not checkers.
Yeah, dude. Yeah, man.
With the approach.
And I'm glad we were somehow able to inspire you. I don't know. Maybe
hopefully it works out. Otherwise,
you know what? Knowing Todd, I'm guessing. I mean, this guy is most.
Yeah, dude, good work. Congratulations. Stay awesome. Like I said, it's chess, not checkers. Like,
and I'm telling you, like, I think I speak for James on this too. Actually, I'm fairly certain that I speak for James on this. But we're huge fans of yours. Seriously, man, we wish you the best, and thanks for sharing that with us, dude. Also, in the interactions, I think we had a question in there. What was the question?
We have two. We had two pretty good questions. So we actually had four, two of which I answered in the Discord. So one was just kind of how bonds work. I answered it kind of to the best of my ability in writing.
Oh yeah.
I do think we have an episode about it. If you wanted to go back and listen. Yeah. Other pants it would be possible for a publicly traded company to have a mutual fund instead of issuing shares.
So the short answer for that one is no.
It kind of. Well, I mean, it's possible. No, yes, you could structure a mutual fund that only owned a single company. But the real question would be is why would you do that? Because it wouldn't make a whole lot of sense. There's a lot of, from a company's perspective, it'd be great. But like from a buyer's perspective.
Yeah, but I mean, like think about like what a mutual fund is. I mean, it's essentially like, it's a pool of money that you buy into directly from the investment company. So like, they're issuing shares, but it's not like, you're not buying a portion of the investment company. You're just entrusting the investment company for a fee.
But to invest your money in stocks in multiple firms, in bonds in multiple firms, and other securities, right? So what I'm saying is like you could make a mutual fund that was just one company, but why would you do that?
Yeah, that just wouldn't make any sense. I mean, it's like a single stock ETF. Like to me, it just doesn't make any sense.
Exactly. It's why would you could. But why?
Yeah. So
and then why would anyone invest in it? Because it'd be like if someone was like, oh, it's only this is a mutual fund that only invests in bonds from this one company that has no stock, only bonds. I'd be like, okay, I'll give you $50 for $1,000. Like there'd have to be a huge discount that would be damaging to the company. There's a company from that perspective. So like that's what I mean. Like, is it possible? Technically, you could. Is it feasible?
Yeah.
Absolutely
not. I mean, I do think it's an interesting question. I do think a lot of people are wondering about that. But yeah, essentially no. Like if you're a company and you're trying to raise money via financing, usually just equity or debt or preferred shares. Yeah,
but again, a mutual fund is diversely invested across multiple.
Yeah, you're buying it directly from the investment company. Like if you can't really trade mutual funds because it's like the way you place an order for a mutual fund is you place an order and then it fills at the end of the day. You can't say I want it sold at noon. It's just not going to happen. It sells.
No, it's where are things when they close? Yeah.
Yeah. So hopefully that answers your question. I don't know, but moving on. Sorry to cut that one short.
Yeah. Tim with a really cool one in thinking, discussing shipping and how much shipping inflation or how much the cost of ocean shipping has affected inflation. And he has some data from his perspective, just because of his experience. I think it's with work, if I'm not mistaken. But that in 2019, it was $2,000. In early 2022, it was $15,000.
Oh,
to ship a 40-foot container, right? From, it was in 2019, 2000, 2022, 15,000. And now it's about 4,000. So twice what it was in 2019, but substantially less than it was beginning of the year.
At the peak, yeah.
And that was from Shanghai to Australia.
Yeah, so it looks like, his rationale, Tim's rationale, just from, what you put in there, I'm gathering, and I could be completely misinterpreting this, but it's saying you're saying retail demand is softening, container shortage, it seems like
it's no longer there.
Which goes hand in hand with retail demand softening. And then the question that gets posed right after that is, could we actually see inflation halt very quickly? I personally, and this is just me, and this is kind of going off what we said last week with OPEC Plus cutting oil production by 2 million barrels a day and nat gas shortages and all that kind of stuff. Because energy is such a big proponent of inflation, I don't see it happening.
For me, it's actually not the... I think you'll see a certain amount of inflation decrease because of this. What I'll say is in the U.S. specifically, the issue actually isn't the ships. The issue is trains, trucks, and longshoremen. That's the problem. It's not the boats.
The shortage of labor? Is that what you're saying? Or?
Yeah, we don't have enough longshoremen, and the longshoremen they want more money. Fair enough.
Yeah, absolutely fair enough.
I'm not gonna fight you for wanting more money. The train, you don't have enough train operators. You don't have enough, and even if you have enough longshoremen to unload the boat, you don't have enough Teamsters trucks to move the product to the trains, where we just barely averted a rail strike here in the U.S. 2 weeks ago, 3 weeks ago. So it's very much, there's clearly, it's not just oceanic shipping. Now what I'll say is this: if the prices have dropped that precipitously this year down to nearly a quarter of what it was, so dropped by 70%. Yeah, you'll see inflation come down eventually, but the problem is if I'm a shipping concern, so if my job is supply chain, is moving things around, great, ships just got cheaper, but they weren't ever, and while they were expensive, the most expensive part for me now is I have to deal with Teamsters, railroad and longshoremen who, aren't thrilled with things. Yeah. And happen to know that they are currently in the best position to negotiate.
Yeah, and I think they're just taking full advantage of that, which honestly,
which I'll be honest, that's just not checkers. Yeah. A business would do that. If the shoe was on the other foot, you would be more than happy to a big business would be more than happy to stick it to them if the shoe were on the other foot. If there was no shipping, if there was very little activity being like, well, if you do this for a lower rate, I'll bring more shipping, I'll bring more stuff through your port.
Yeah. Well, so let me ask you this then. So, I mean, we all saw the job opening survey last week, and we saw non-farm payrolls, and I think both of those items suggest that the Fed has a lot more work to do in terms of taming inflation, right? Or at least stabilizing, because the job markets have been pretty unstable for the last 2 years, right? I mean, 2 job openings for every single worker that there are available to fill them. It just doesn't make any sense. So I think because of that, I think the Fed is going to get a lot more aggressive, hopefully, in terms of taming inflation, but I think that's also going to crush the job market a little bit. So do you think that could lead to inflation coming to a halt, as Tim kind of asked in that Discord question? That was a really loaded question.
Yeah, but that's big. I don't
think so. I just think there's too many.
The short answer is no.
Okay.
and the long answer is there's still enough of the other things that will drive supply chain demand in the U.S. at a time, but it's already weak or fragile and inefficient at best right now. Well, and I'll be honest, the Fed doesn't have any tools to fix the supply chain issue. The administration has tools, but they're not particularly efficient tools.
Yeah,
and what it really boils down to is
Well, I mean, there's nothing out there that's going to fix the supply chain woes tomorrow.
Nothing's going to fix the railroads tomorrow, because you can't build a whole new railroad overnight.
No, you can't.
Now, in theory, you could train more Teamsters, you could train more railroad workers. But the next thing is you have to give them economic incentive to do this that's in their best interests.
Exactly.
And that's not really, I mean, the railroads can be quite lucrative.
Yeah. But the thing is, like, the hours suck, It's a tough job.
It's a hard life.
Yeah, it's a tough job. But on the bright side, I will say this, and this is kind of related, but not related, but kind of related. The Global Supply Chain Pressure Index, the GSCPI,
is starting to drop.
Looks a lot better. Looks way better. Yeah. I don't know how it's measured, but it looks a lot better.
It'll be sticky. So, I think we'll be to January and February before we start to see real supply chain pressures easing in the US.
Yeah. Well, I do think, and like I keep referring to this tweet because it's such a great tweet from someone that tweeted at us. Speaking of which, like we mentioned earlier, at Drunkenomical, I said something like, will 75 basis points really fix supply chain pressures? And they said, well, no demand means no supply chain issue. And I'm butchering the tweet, but that was such a brilliant tweet that I was like, wow. And it's true. It's actually, we're seeing this happen. Demand is slowing down.
Essentially that's what the Fed is having to do. The Fed, in this case, the Fed has a hammer, and this is a job that's for, this is a job for a screwdriver, like a screwdriver. The Fed's got a hammer.
The nail's got to go in.
It'll go in. They'll make the screw go in. They can make it go in. It's not necessarily
it just might not be very comfortable.
I was just saying, like, they got to use the tool they've got.
Yeah, exactly. So, and I guess, one last question in there. We mentioned that the Fed balance sheet, if anybody wants to see what the Fed balance sheet looks like, every Thursday it's updated. You can look up the H.4.1. It's, that's the document that tells you what's all on the Fed's balance sheet. He's saying that it looks like there's 27 billion and not 2 trillion in MBSs. JK Jokey. I'll be honest with you, JK Jokey. First of all, love the user ID, but I'm seeing, no matter how I look at it, I'm seeing 2.7 trillion in MBSs. And the way I'm seeing it is...
Let's see, so I'm looking at...
So I'm seeing 2,698,158, right? So 2,698,000, right? But that's in millions. So 2 million is 2 trillion. That's what I'm seeing, right? And that's all MBSs, right? And then of course from maturity over 10 years, I'm seeing 2.6 million, which really could translate to 2.6 trillion. That's what I'm seeing. I'm not sure what you're seeing, but if you want to drop it a screenshot, man, I'm more than happy.
So there are 6 zeros behind that you are not seeing.
Yeah, so 2.6 million times 1 million is 2.6 trillion.
Yeah,
so,
or 2. And it's 2.6 blah blah like 9 2.8, so it's like it is 2.7, so it is 2.7 trillion.
Yeah, so that's what I'm seeing, and then over 10 years, I'm seeing 2.64 trillion dollars worth of MBSs that have a maturity of over 10 years, which in case, if people want to know why that's significant, it's really because QT, quantitative tightening, is going to start ramping up here. I think they need to start unloading that pretty soon.
Yeah,
which
in a different way. They can't just let things expire.
Exactly.
They have to start unwinding their position.
Exactly, which kind of leads perfectly into real estate, right? I mean, why avoid this subject anymore? I think we've been putting this off for too long. Just because because real estate is so weird. It's not like it's, one size fits all, it's like the real estate market in New York is completely and not even similar
to the real estate market in
Lincoln, Nebraska, where you live, or Las Vegas, Nevada,
or Detroit,
or
Vegas,
or Dallas, or whatever, or San Francisco, right? So it's just beast of a subject.
Yeah. And like we could sit here, we could talk about a national real estate market, and it's useful. Like those are useful, but really, think of a real estate market kind of like a presidential election in the U.S. It's not one election. Mm-hmm. It's not even so that's like it's the real estate market. It's not one market, just like it's not 50 markets. Although the 50 markets, like each of those states, is more accurate representation of what's happening there than the national market is of them. But then you break it down again. Let's go to cities. Okay, let's go to counties. Let's go to zip codes. Let's go to school districts even, which is a weird way to think about it. But the smaller a section you're looking at, the more accurate.
Yeah, I do appreciate the electoral college comparison there. I'll just say that real quick. Because
I think it's the easiest way. It's like
exactly. You're absolutely right. I think I just wanted to admire that metaphor because I thought that was brilliant.
And I do what I can.
Yes. Cheers to that. Here,
because I love what I was explaining to someone today about the presidential. I was like, well, it's not one election. It's actually 50 elections, and it's not actually 50 elections. It's actually, and then you go down to the counties, and it's actually not even really these counties. It's each voting precinct.
Right. Exactly.
And that's how many elections you're actually having.
Yeah. And that's that's how many real estate markets you're having. Right. But it's, like Phoenix, Phoenix where I live. I mean, there's not one real estate market in Phoenix. There's like 1,000.
It all depends on the neighborhood and what it can call itself. Yeah. Like when I was growing up, I grew up in an area of Orlando or the Central Florida area called Winter Park. And you could buy the same house in Winter Park and pay $100,000-$200,000 premium versus buying the same house in just Orlando. Right, people, and why is that? Well, there's the perception of the neighborhood, there's the perception of school districts, and maybe there's some value to that. There's some truth to that. Maybe it's also just that
it's stuff like if Intel builds a factory in one of these cities, right? That's going to drive up property values, stuff like that, right? If a big company decides to move their presence into that area, for instance, Tesla moving to Austin or whatever, like that's going to drive up real estate. It's going to drive up real estate prices.
A bunch of college kids moving into the neighborhood tends to drive real estate prices down, right? So there's a reason the North Bottoms in Lincoln are the North Bottoms in Lincoln. It's all about who your neighbors are.
God bless the Bottoms, man. A lot of house parties there. A lot of good memories there, man. A lot of good memories there.
Yeah, buddy. But I mean, all right, housing market, where are you at?
Yeah, well, I think we should preface this by saying the 30-year fixed mortgage average about a year ago was sitting around 2.9. Now it's at about 7. Right. So it's right. Wow. As of Thursday, October 6th, it's at a really demonic rate. It's at 6.66, but it did peak at above 7, I think, at one point.
Yeah. It was at one point I thought I saw 7.12, and I was like,
yeah, 7.12. Yeah, well, because like a lot of people are talking about credit spreads widening. The Fed funds rate has gone up like crazy in the last 12 months, but the 30-year fix has gone up a lot faster. It's outpaced the Fed funds rate by quite a bit.
Oh yeah, and that I think is so. Initially, there was this period in September where you started to see the 30-year fixed rate actually kind of coming down. Despite in August, really, the Fed funds rate actually came down despite not the Fed funds rate. Wow. In August, the 30-year fixed rate, the average 30-year fixed rate in the US actually went down. Despite the fact that they just raised interest rates by 75 basis points. And it was the sentiment in banks that they were going to have to slow the raising of the rates at some point, and that the banks were sitting there and they were calculating, and their calculus said that there was going to be a lowering of rates at some point soon, which would allow them to keep a lower 30-year fixed rate than the current data was telling them. But the prediction of a lowering of rates later meant they could go, okay, we don't have to raise it quite so high because we'll do less business. Obviously that either pessimism or optimism, depending on how you want to look at it. Because the pessimism is saying that the reason the Fed has to lower rates is that the economy is starting to slow down. The optimism is them going, they'll lower rates. It'll be fine. Obviously, that's all gone away. And now they're going, well, we have to raise our rates, the 30-year fixed rate, because whatever this is something else entirely.
Yeah, well, and it's kind of like, going back to what the economic data last week. I mean, the JOLTS report and non-farm payrolls both kind of suggested that the Fed has a lot more room. They have a lot more room because the labor market is still very strong. So both the data on Tuesday or Monday or whatever, and on Friday both suggested that. So, but the weird thing is,
like looking at housing. We saw a market that was so used to 3%, sub 3% interest rates, and saw house prices just skyrocket because of that, because it was cheap. I mean, money was the cheapest they had been seen. What I can say is, like, the reason I make this distinction about like why I worry about 5,000 different housing markets instead of one big housing market is because nationwide the housing market is down about the nationwide the average house is down about 2% in value. We're seeing housing prices come down 2% since June of this year.
Yeah, which is like the biggest decline, fastest decline that we've seen really since the GFC, right? Financial crisis. Yeah,
so we've seen it in quite some time now. Let's compare that. So, like,
well, I mean, let's just look at the cost of borrowing, the cost of buying a house, right? Because a lot of people are like,
the cost of buying a house is through the roof.
Yeah. So the price of the actual house has gone down 2%, which we're sitting there looking at like, that's great, but because the actual 30-year mortgage has more than doubled
in its interest rate.
Like, how much does that actually increase the cost to buy a house? Let's pull up that Excel sheet.
Let me just look at my Excel. So what are we going to say? We're going to say the average house is $250,000.
Well, I mean, not anymore, but let's just keep that constant, right? So let's just say just off of that, like, let's keep that constant. The rate goes from 2.9 to 6.66. How much does that increase?
Let me change. So 2.9. So I have it set at 2.8 and 7, but we want to do to 6.66.
Yeah. So 2.99 to 6.66.
All right.
How does that?
Our interest rate increases by 131%. Right, we're seeing an increase from 2.88 to 6.66 is 131%
increase in interest rate.
Interest rate. Now, what does that sounds like? For 100% just means it doubles, and then 30% more
on top of that. Yes,
on top of that. So that's how that means. So we're looking at
So if you add up all the interest payments,
so the total interest payments, if we were buying this house in July of 2021, rounding up, we'd pay $124,000 in interest
on a $250,000 house. Right, so you assume that you're borrowing
roughly half,
or assuming that you're borrowing $250,000 to buy a house, right? So let's say $50,000 down, $200,000 to buy it.
To borrow $250,000 would cost you $124,000.
Okay, perfect. Yeah. Right? Okay, there we go. So 50. Let's just say 50. I mean, who cares what the down payment is, right?
Exactly. To borrow $250,000, it's going to cost you $124,000. That's rounding up by about $400. If you were to do that same thing today, get that same loan, borrow that same $250,000
on 6.6%.
And this is rounding down. It'll cost you $328,000 to borrow that same amount of money.
So $124,000, right? To what? $320?
Yeah, you're paying $204,000 extra dollars to borrow. So you are now spending. You're paying more in interest than you are borrowing. Like you're paying more in interest than the total amount you borrowed initially.
Yeah, I mean, for the longest time,
you're paying that back too. So
for the longest time, people were doing that.
Now in a high inflation environment, that could
be beneficial.
Inflation hurts the creditor more. So this isn't quite as bad as it looks.
Yeah, I mean, that's part of the reason why the whole. Remember last week we talked about guilty as sin, the GILTS, the gilts, the UK bonds, right? The default rates went up because they're high inflation. Inflation hurts creditors. Why does it hurt creditors? Because if I loan James money and James pays me back the inflated dollar, I'm losing buying power, right? So
exactly.
So
borrowing money in a high inflation environment or borrowing money prior to a period of high inflation can be beneficial.
Yeah, exactly.
If you're the borrower.
Yeah, because you're paying back the dollar after it's inflated, right? So
you're paying back a decreased buying power. So you're not paying what you borrowed. Well, I mean, you should obviously a creditor is going to calculate this when they do their interest rate.
Yes,
but
exactly.
How can you prepare for this?
Yeah. Well, I mean, why do you think credit spreads with based on the Fed funds rate to mortgages? why do you think it's so wide? And I think that's exactly why. It's because I think personally, if you're someone that is in the business of lending out mortgages, you're looking at the timeline, you're looking at the Fed and the way they've been behaving. You're like, there's no way they're going to tame inflation anytime soon. We're not seeing a soft landing, and because of that, this is the risk we're calculating: 7%. Boom, done. Sorry.
Yeah.
Too bad.
I mean, let's put it this way: a third of housing markets in the U.S. have experienced a greater than 3% decline. Right. In some cities, it's already hit double digits. You're seeing some parts of California, San Jose, San Francisco, 13%, 11%, Seattle's 10% decrease in housing prices.
So what does this? So what does this mean for the broader economy? You think? Because I think there is going to be a liquidity crunch in the housing market. Because why would you want to buy a house right now when you're paying more for the loan than than the actual loan?
Well, right now it doesn't necessarily mean anything. It indicates a major slowdown. It shows that people aren't willing to pay what they used to be willing to pay. Mm-hmm. The issue would be, and you and I were talking about this, and this was your point. The issue will come if people have to start selling investment property.
That's what I was saying. Yeah,
and you're right. So when you see people start quitting the Airbnb business, when you see people starting to quit
but I think it's just kind of like it goes hand in hand with that their property values are going down by about 2%. Let's just say nationwide, right? Let's just do the actual average. Obviously, it's more drastic in certain areas. It's less drastic in certain areas of the country, but it's gone down 2%. And if they're seeing a bigger increase in the decline of housing values, I said that backwards. And if you're a real estate investor and you're sitting on a bunch of investment properties and some of these are leveraged, right? At that point, you got to be like, okay, look, I gotta de-risk.
Well, so the real issue will come if, and this is a big one, is if you're an investor on a property and you got a fixed rate, you're probably unaffected. You're probably still going to be able to afford your payments if you did this right. Now, if you went the other way, if you decided you didn't learn anything from 2008
and you
wanted to get and you do an adjustable rate mortgage, this is where you run into trouble because that rate is going to adjust. That payment is going to skyrocket, and if you can't afford it, you're going to have to sell the house. The thing is, if it's not just you, you're going to drag down, or if you own more than one property, you're going to be compelled to sell. Well, it's a margin call.
Yeah, but I do think
it's basically what it is.
Yeah, but I think the problem with that, and I'm not disagreeing with you. I'm just I'm furthering your point. Is I have heard a lot of smart real estate investors say I don't see how interest rates are ever going to go back up. Which I'm like, really? That's just not sustainable at all. There were people that actually believe that interest rates were not going to go back up. And those people, I think, maybe they took on those adjustable rates because they just wanted to take advantage of the environment that they were seeing. Maybe they got a more friendly loan because they took on a more adjustable rate, but, it was obviously short-term goggles. And now I think they're facing that situation. They're facing the situation where they're just like, okay, plummeting house value, I got to sell before it goes down even more. And I think there's going to be enough of those people.
I have to trim my loss.
Yeah. And maybe it's not a loss. Maybe it's just, maybe they just want to get a capital gain out of it. But they just want some sort of capital gain, right?
So most people I know, when they see their houses valued at $550,000, if they bought it at $300,000, and they see it's valued at $550,000, and then it goes down to $500,000, they'll be like, oh, my house is I'm losing money. And it's like,
no, you're not.
You still you still have the house.
Yeah. But if you're living in the house, it doesn't make sense for you to panic sell your house that you're living in.
No,
that doesn't make sense. Not financial advice. I'm not saying I'm not saying not to do that, but I'm saying it really doesn't make sense if you think about it, because you're living in the house. But if you have an investment property, it makes a little bit more sense. And I do to your point, that was from my point earlier. I do think there are going to be enough real estate investors that are going to be like, look, I got to part ways with this property because my book is getting smaller because these property values are shrinking. And they might have some investors that they need to please, and they say like, "Hey, this is this is the dollar value of the real estate assets that I own, right?" So
maybe you bought this, bought this house and you bought it for not very much money, and you're looking at the amount of repairs between the next tenants, and you're going, actually, maybe it's better for me to sell because yield on this property is going to be less great if I have to make these improvements, if I have to assess the property. Yeah, there's a lot of factors that are going to go into this. I think the housing market's is due for a major correction. I think you're seeing these drops that are some of the strongest may end up being the third largest drop in property value in the history of U.S. property and U.S. real estate.
And I think to counter that, I'm kind of playing both sides of the argument here, and I'm sorry to kind of spin everybody for a loop, but I want to be as perceptual as I can possibly be. But I really think with home builder sentiment doing what it's doing, I mean, it's come down quite a bit. I don't know if the declining value in the housing market is going to be as accelerated as people think it's going to be, just because the supply just isn't going to be there.
No,
it depends. Like,
I don't think it'll be. I don't think this will be like the precipitous collapse that we saw in 2008, or that obviously happened to real estate during the Great Depression. I think this will be more like because of high interest rates, because of high mortgage costs, you're going to see people coming out when they're buying, and they're going to say, "Look, I'm not going to spend more than $400,000. And you're going to see people who are, and it'll start with, because some people are going to be fine with it. They're going to be like, look, I bought this house, whatever. I've lived in it for 25 years. My kids are grown and out of the house at school. I don't need a property this big. I'm leaving. Yeah. I'm downsizing. These people that doing that, if you're like, look, I'm retired. I've lived in this house for 40 years. I'm more than happy to sell it at that, because it's a buyer now. The problem will be is when you start to people that are like, I need to sell or I need to move. And I want to sell my property. And it's those people who are going to sit here and they're going to come out the door and they're going to be like, I want 400,000. So it's going to go, I could give you 350. And they go, what
are you going to do at that point? Wait, right? You have
and when no one comes, they go, okay, I'll accept the bid.
Yeah, exactly. And the thing is, a lot of times when people offer to buy a house, that offer doesn't stay on the table for very long. I mean,
well, no, because you're usually only pre-approved for your loan for 30 days?
Yeah, exactly.
If that long?
So sellers, I think, are, unfortunately, they're losing power. And I think, and I think a lot, if that just builds up over time, it could lead to a crash.
Well, I don't think it'll be a crash. I think it'll resemble more like that.
Maybe crash is a little bit dramatic.
For me, it's that early period in 2008 where it's just a steady decline back to reality.
Well, I think this is what this all is, right? I think, right? Markets. I think markets are. The correction there might be a little bit more accelerated because of the $9 trillion balance sheet that the Fed is currently sitting on, or really at this point, $8.5 trillion balance sheet that the Fed is sitting on. Yeah, but I think the market correction is going to be much faster than the economic correction, because I think this recession that we're in, it's going to be a long, shallow recession, and I've been sticking by that for a long time.
I think you're right. I absolutely think you're right now. Yeah. For me, it was always I fully expect by the end of the year that the markets will reset themselves to pre-COVID levels.
Yeah, to be honest with you, I think the markets might even go...
And we're not that far.
Well, so what Jamie Dimon said, right, which was the big headline from earlier today, was Jamie Dimon was like, I see a 20% decline in the S&P 500, which I'm like, okay, well, let's just take a look at the broader markets in general, okay? Russell and Dow are about, they were trading at about pre-COVID highs. So small caps and the Dow 30. Which, I mean, I think that's a little bit alarming, especially because of their correlation with the S&P 500 and the NASDAQ. But the S&P is about 200 points from pre-COVID highs. NASDAQ is about 700 points, which, NASDAQ is about 11,000, 10,000-ish right now. 700 points is nothing. SPX is about 3,600, like we said earlier. 200 points is nothing. Mm-hmm. So... it's nothing.
Now the next thing I'll say is this: is statistically speaking, we're going to get back to those COVID highs. We're going to go back
the post-COVID highs, right?
Yeah, the post-COVID highs. And the reason I could say we're going to go back there is because we've been there. It's no longer this it'll never happen. It's this, we've been there. We know what it's like. The systems are already modeled to go there. And so we'll go. It'll happen. Will it happen in the course of 6 months because of free money? Absolutely not. It'll be a much slower, I would assume a much slower appreciation of value, because it's no longer based on just, you remember us at any point in 2020 or 2021 where we would sit here and say why is the price up? This is bad news. And the answer was always, because it could have been worse.
Well, and because
it's because it wasn't as bad as they thought it was going to be.
Right. Of course.
If someone walks and as I said then, if you walk in and you tell me you're going to have to cut my hand off when I thought you were going to cut my arm off, I'm not going to be like, oh, hooray. Yeah, I'm still losing my, I'm still losing my hand.
Yeah. But I really think a lot of it was just, I think whenever there was a headline about the Fed was going to be dovish, or there was an event that could mean that the Fed will react to this event in a dovish manner, which dovish just means easy monetary policy, right? Whenever there was that kind of event, markets shot up. And those events included, okay, oh my God, the labor market is tightening, right? Labor market tightens, good news is bad news is good news. Labor market is tightening, that's usually bad news. But that meant, okay, the Fed has to react a little bit more dovish to this news headline. And then boom, everybody bought in, just like last week, right? Does it make sense? Absolutely not. And to be honest with you, kind of going back to what we said earlier, Jamie Dimon said 20% drawdown. Once we hit bottom, there's going to be a 20% drawdown. That's what Jamie Dimon said, not me. Personally, I felt like that was a very easy, if you will, easy prediction. I don't want to say we're going to hit COVID lows.
No, right? I don't think we will,
which is about
because there's no reason to.
Right. I mean, that was obviously a very dramatic panic sell, right? And if you want to know a little bit of reference, right, S&P is about 3,600, COVID lows 2,200, so 1,400 point decline in the S&P 500. I don't see that happening. Could it happen? I think so. I mean, we were due for a correction before COVID. Honestly,
absolutely.
So
it's possible. So would I see 3,000?
I mean, I honestly I think the pre-COVID highs. Personally, I think it's going to blow right past that. I mean, not like in one trade, but like I think it's going to go below the pre-COVID highs.
I think we will too, but I think we'll stop there for a breather.
Yeah, I think we will too. I think there's going to be I think that is a beast. Like I said, a beast of a resistance level. Like we're going to trade around there for a long time, and then all of a sudden, as soon as we break through, it's just going to be, where's the bottom at? And I think that if the bottom is at 2,200, I'm not saying that it is or it isn't. I'm not a trader or whatever, or a financial advisor or anything like that. If the bottom is at 2,200, would it surprise me? Not really. But that's just me, right? that's just a guy drinking whiskey with an economics problem, just spewing his opinion.
Yeah,
that is not very merit-based.
I absolutely agree. Could we end up there? Could we end up there? Yeah, of course. There's always markets can go one of two directions. The best part is that they can only go to zero. Yeah. They have infinite upside.
Exactly. And the reason why I come up with that number, the 2,200, or I guess if you want to be exact, the 2191.86. That was the COVID low, right? When March of 2020, I think was when that happened.
Like, late March, early.
Yeah, April. I think if COVID never happened, I think we probably would have gotten there, by itself, right? Like, I mean, there was going to be
something had to give, and it wasn't going to give in a positive way.
Yeah, I mean, at that point, we had 12 years of a bull market, so
that was fueled by easy liquidity, by cheap liquidity.
Yeah, by QE, by low interest rates, by extreme dovish behavior by the Federal Reserve.
The best part is I was sitting there watching the Fed Reserve or the CNBC one of the days when they started the rate raises. And you just have them sitting here as the markets start to show red, and they're like, well, very clearly, low interest rates and cheap credit is the crack
is the reason
of financial markets.
Yeah, it's the reason why we had this bull market. Yeah. So, I mean, personally, that's the reason why that's my thesis for why the COVID lows are potentially, maybe that's the bottom. Maybe that's the bottom at the end of this recession. Maybe it is, maybe it isn't. Maybe we do just bounce off.
See, the funny thing is I'll say we have had economic development and growth that I think puts us in a better economic place than we were before COVID in terms of workers knowing their value and wanting to be paid. And I think that it is that demand by Main Street to extract wealth from Wall Street. And even then, not like subtract the value of Wall Street, just say, hey, Wall Street, you can only take, you can't take as much as you used to. You have to take ever so slightly less.
Right.
And I think that's gonna.
I honestly, like, if you really want to look at that from like a market standpoint, that really means that the bottom line is much further from the top line, which means a less convicting reason to buy a stock. Unfortunately. But
sure,
that's
and I'm not fighting you on that. I'm saying the economy as a whole is stronger and bigger.
Well, I mean, honestly, I'm a bigger fan of that.
Like, so we'll see. I think the bottom is not as low as that, just because even with this reality check, the news is still better.
Yeah, and just so you guys know, I'm no expert. I don't have any CMTs or CFAs or anything like that. I'm not an expert, so don't take this as advice when I say that I think the lows could be the 2,200 SPX level. Just because I really don't know. This is just a pure guess. I'm making a bet, drinking Irish whiskey with a friend of mine.
Yeah, I think, and for me, again, I'm not a CFA, I'm not a financial advisor of any kind. Don't take this as any kind of investment advice, but my view is I think we're going to end up back at the pre-COVID highs. Everyone's going to kind of stop and go, well, that was really weird. all right, let's be realistic about what is the world we're currently in, saying, doing, blah, blah, blah. Let's go back to basics. Let's go back to basics. And okay.
Let's look at balance sheets.
That was weird, right, guys?
Yeah, let's look at balance sheets. Let's look at cash flow statements. Let's look at all those things, right?
Exactly. And let's go make some good choices. Now let's go make some money. Let's go make some good choices.
Yes. Let's not trade JPEGs and think that we're going to become millionaires overnight.
What were we thinking? Could you imagine? And this is the wildest thing for like to me, like NFTs and stuff. It's like, okay, could you imagine if an investment bank got in on the Beanie Baby craze? Like, because that's what it is.
Dude, I mean, the Fed balance sheet is $8 trillion full of Beanie Babies, dude. What do you think they're holding?
I knew it. I freaking knew it. All right.
You know what they do need on their balance sheet, though, is they need some Drunkenomics hoodies. That's just, honestly,
absolutely.
At that point, why would you even unwind?
Look, I'll be honest. I don't think the Fed has any. They've lost some credibility, and if they want to get it back, let's be honest. They walk out in a Drunkenomics hoodie. Dude, they're credible in my book. I'm like, all right.
Yeah. And where could they get one of those Drunkenomic hoodies?
Well, if they were to check out drunkenomics.myspreadshop.com,
my man,
they could find all the Drunkenomics merch that their hearts desire.
They can get the best looking hoodie.
It's not just a marketplace for the Fed, it's a marketplace for you guys too. And
exactly. It's not just for Jerome Powell, it's for all of you. And seriously, if you do buy a shirt, if you do buy a hoodie or a dog bandana or whatever it is, feel free to send us a picture of it. Like, honestly, I love seeing that.
Yeah,
that makes my day.
I think some of them are great when you guys are out and about. It is like, or when I'm hitting up the Treasury and walking by the Fed and just going like, what up? They put this fence up to keep credibility out.
Yeah, but here it is. So any support in that manner, we'd really appreciate. From there, you can also leave a tip in the tip jar at patreon.com, patreon.com/drunkenomics, DRUNKENOMICS.
It helps us keep the lights on. The
totally do ain't gonna pay for itself.
Yeah, it helps keep the lights on, the ice frozen.
The liquor,
of course, the fruit fresh, the
liquor cabinet stock. Most importantly,
it keeps us playing chestnut checkers. Let's put it that way.
Yeah, exactly. It keeps us playing chestnut checkers. But yeah, I mean, from there, seriously, I appreciate you guys listening. Every time I have a drink with you guys, it really makes my week. So thank you so much for having a drink with us.
Feel free to write us a review on wherever you find your podcast. And
absolutely, yeah. Feel free to add us on LinkedIn. I'm always happy to connect with anybody that is a drinkonomist or an econoholic.
I know. It's always fun.
Yeah.
What's that thing, Aaron, that you're always saying that I need to do with my week?
Is it play chestnut checkers? Oh, I already told you that, didn't I? No, it's...
You did. No, it's the other one.
What is the other one? My memory is faded right now. I've had too much...
Is it that we always need to stay drunkenomical?
That's what it is. Stay drunkenomical, my friend.
All right. Cheers, my guy.
Cheers.